Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Oracle reports strong sales and issues an outlook that suggests little let-up in demand for AI computing. We break down the results.
Plus, Meta plans to deploy 4 new generations of its in-house AI chips by the end of 2027 to help power its rapidly expanding AI workloads.
And Uber will let customers hail robo-taxis from Amazon Zoox, starting in Las Vegas this summer. We'll hear from both companies in an exclusive interview later this hour.
But first, we turn our attention to, again, geopolitical risk, a macro picture that actually sees tech outperforming. Look, stocks have got a relative lid on them, even as we see the IEA weigh in, the nation's G7 trying to add to oil supply and reduce those tensions amid rising prices. But Brent crude is still up 3.4%. Despite that inflationary tug higher, we're seeing some of those tech names managing to outperform. We're up 0.4% on the Nasdaq 100. And Ed, you can lead us a little bit as to what's going on underneath the hood.
Yeah, there's one big mover in technology, and it's Oracle, on track for its best day since September, up around 11-12%. The numbers are very clear. Sales of $90 billion for the fiscal year starting in June. Capital expenditures holding at $50 billion. The backlog is rising. And so the market's looking at this and saying, OK, the AI demand story is intact. Now it's about execution risk and credit risk. And how is Oracle going to manage cash to fund all of this? There's a lot more behind the numbers, Caro.
There is, and we can dig into them and the results of Bloomberg's Brody Ford. Look, they did enough to stay off any anxiety. They're sticking to just that $50 billion in capital expenditure. And the numbers thus far, particularly in the offering of cloud and the infrastructure side, really strong.
Exactly. Right now, it's all about, as you both said, that execution risk. I mean, we have to remember that Oracle was kind of the poster child for Wall Street getting scared about all these big data centers not going quite right or the margins being upside down. But the results last night gave a lot of comfort, right? They showed that things are progressing, they're recognizing revenue, the margin is reasonable. And so these are kind of all the messages that investors were hoping to hear from Oracle.
Brody, take us inside the earnings call. What was it like, going into it? We had broken this story about Abilene not expanding from what was a set 1.2 gigawatts to potentially 2 gigawatts, and the markets reacted. As far as I can tell in the transcript, it didn't come up. But there were lots of questions about how Oracle's going to pull this off.
Yeah, for sure. I think the big question underlying a lot of it is, how are the big builds going, right? And the indicator that some of these are going well is that the revenue is getting recognized. That means capacity is getting handed over to big customers like OpenAI. The line in the transcript I thought was interesting was that their new co-CEO, Clay McGuirk, said that 90% of what we delivered this quarter was on time or ahead of schedule. I think that was probably a kind of response to a lot of anxiety out there about potential delays or things kind of going sideways, that, despite the noise, we're handing over capacity just like we said we would.
Brody's got the Tech in Depth newsletter out about how Oracle's pulling every lever in its AI cash crunch. Really worth reading. Brody, thank you very much. That's the story right now, right, in markets. What is happening on the demand side? What is happening in the supply side? And what is happening in the cash supporting all of it? Matthew Weir, Goldman Sachs Managing Director, joins us now. It's really interesting because for a very long time, we were zeroed in on capital expenditures, and that was the be-all and the end-all. There are stories on the Bloomberg terminal today about the credit profile and CDS, for example, on Sure. Oracle. Are investors starting to look deeper and at different data sets to assess the health of what's going on?
Yeah, absolutely. We look, though, at the structure of the national economy, and we look at CapEx as a share of GDP. What's interesting to note is that capital formation as a share of GDP is the same level as a percent as it was in 2018. So while we've seen a tremendous amount of investment, especially in the tech and AI space, from a national standpoint, it doesn't feel imbalanced. Now, rightly, investors are starting to wonder, what is the return going to be on all of the investment going into AI? We think that there has been a lot of excitement, perhaps over exuberance in places. But clearly, as you mentioned, Ed, that there is a lot of demand still. And that's something that we think can continue to go.
You have a very clear line, which is the primary determinant in equity markets and equity prices is earnings.
100%. Absolutely.
Well, we just had an astonishingly detailed earnings print from Oracle.
Yes.
What did you learn about the world from it?
Yeah, well, I think going back to what you just said, that demand for AI CapEx is still very, very high. When we think about what determines equity returns, whether you're looking at history since World War II or even the last year, for the S&P 500, 80 to 90% of the return comes from earnings. And so the outlook for prices is really predicated on, do you expect earnings to grow? And we do think so. We think earnings growth for the S&P 500 will be about 10% this year. That is largely predicated on an economy that we think will be growing above trend. We're expecting 2.4% real GDP growth versus trend growth for the U.S. of about 2%. That we think will generate that 10% earnings growth. We think, though, in our base case that the total return, though, for S&P 500 will be about 7%, which means not all of that earnings growth makes its way into the total return, primarily because we think multiples will come down a little bit from their currently elevated levels.
Interesting, because you've sort of been talking about the tech sector not being in a bubble, Matthew, talking about how valuations are relatively reasonable, and certainly Oracle's come down some in terms of its own PE ratios. But talk to us a little bit about the anxiety in the software part of the business. And Oracle
absolutely.
Spoke and pushed back against that. Have you pushed back against that more broadly?
Yeah, we do think that there should be some concern about the software sector. This, though, is reminding us of a few episodes historically, whether it was the global financial crisis and there were concerns about the U.S. financial sector and existential concerns. If we go back to COVID, there were concerns about the office real estate sector and whether it was dead. We don't think this time is different. Investors, unfortunately, tend to move en masse, especially when pessimism takes over. We think this time is no different. Reality is probably somewhere in between what we've seen in terms of the status quo and the existential concerns that investors have. We think of this more as an evolution of the sector. There's certainly a competitive risk, but we certainly don't think that this is an existential one where there's so much focus on the terminal value. We think these are absolutely very competitive companies that will continue to evolve over time.
There was a lot of anxiety in the market initially about software. And then, look, there was the geopolitical risk that we're now combating day in, day out for a 12th straight day over with the Middle East and conflict with Iran. Matthew, does that change in any way your perspective on investing into this moment in where you are in the market?
Yeah, we're very focused on Iran, and it's terrible from a humanity standpoint. I think, though, we would focus, though, on from an investment standpoint that this resembles what typically happens when there's a geopolitical shock. Over the near term, there is a reaction by financial markets. What we've seen historically, and specifically, we've looked at the last 40 years, there are 21 airstrikes in terms of the U.S. in the Middle East, and we do see some patterns emerge. The first is that the initial reaction in markets is that risky assets like equities initially sell off. But then we see the dollar appreciate, we see oil rise, we see bond prices rise. But after about 8 weeks, fundamentals, whether economic or corporate fundamentals, reassert themselves, and the prior trend in financial markets resumes, such that after 8 weeks, 95% of the time, U.S. equities are actually above their pre-strike levels by an average of about 4%. So as a consequence, we haven't changed our views. We have a key investment tenet at Goldman Sachs that history is a useful guide. The words "this time is different" we think are very dangerous. We think that history will repeat itself here and eventually markets will resume their upward trend.
We're every day trying to understand the long-term impact of AI on inflation and labor markets. And I know the Goldman House call is that AI may displace 1 million jobs a year.
Correct.
But there is also job creation happening in parallel. Just what you said about how one might approach that as an investor from your desk and your perspective. What happens in the short, medium, and long term?
So we think technological innovation is a feature and not a bug of the U.S. equity market and the U.S. economy. The U.S. economy is by far the most innovative globally. It's a key reason that we recommend our clients be strategically overweight U.S. assets. Now, certainly AI is going to boost productivity, and unfortunately, it is going to displace workers. But as you mentioned, Ed, there's a tremendous amount of new job creation each year. Bear with me, some numbers here.
Sure.
There are 170 million jobs in the U.S. Each year, there are about 25 to 30 million jobs either lost or destroyed. But on the other side of that, and this is creative destruction, new jobs are created, and there are more new jobs created than jobs destroyed. So as we put that 1 million number into context, we think that a lot, if not all of those jobs lost to AI, will be replaced by new jobs. Think about the investment we've seen so far, whether it's the construction of data centers, think about rising financial market prices, that's increased net worth, and it's increased consumer consumption. And so as we think about the net impact longer term, we're bullish, and we think that this is something that will be additive, even though over the short term there will be some tough adjustments.
Matthew Weir of Goldman Sachs, great to have your expertise today. Thanks for coming in. Meanwhile, up next, Meta plans to deploy homegrown chips to handle AI workloads. I'll have the details next. Ed, what are you looking at?
Yeah, also looking at shares of Uber and Amazon. So Uber is going to make robotaxi rides through Zoox's robotaxi available this summer in Las Vegas and then next year in LA. And when the news broke, Uber really popped in pre-market. It's off session highs, but we're going to speak with the CEOs of both companies in an exclusive interview later in the hour. This is Bloomberg Tech.
This is Meta's chip lab in Fremont, California. Inside, the company is developing the next generations of MTIA, short for Meta Training and Inference Accelerator, its in-house AI chip program. It's a long-term effort to build the most efficient architecture for Meta's internal workloads, with 4 new generations of chips planned over the next 2 years, from ranking and recommendations to large-scale Gen AI inference. When chips come in from the fab, this is where they're validated, tested at the chip, rack, and workload level before deployment into Meta's data centers. MTIA 300 is already in production, supporting ranking and recommendations training, helping decide what shows up in your social feed. Those go into liquid-cooled servers like these. MTIA 400 is moving towards deployment, expanding into broader AI workloads, including Gen AI. Future versions 450 and 500 push further into Gen AI inference, with deployments planned in 2027.
The effort hasn't always moved as quickly as Mark Zuckerberg and Meta had hoped. Meta has made some acquisitions. It has tried to make some others in an effort to strengthen its in-house chip talent and accelerate progress.
AI models are evolving faster than traditional chip cycles, so Meta is speeding up the design process, aiming to improve performance, cost, and power efficiency at scale. At the same time, the company is striking major supply deals with leading chip makers, securing gigawatts of AI computing capacity. The strategy is buy compute at scale from Nvidia and AMD, but also use custom silicon where Meta's workloads are uniquely its own.
Because in the AI race, it isn't just about the models, it's about the compute behind them. Okay, so we broke the story on this one this morning. The reaction in Meta shares kind of muted. Remember, Meta's still a big buyer of Nvidia and AMD GPUs. Let's get more on Meta's own chip plans, the in-house and custom silicon, with Bloomberg's Riley Griffin, who came with me to Fremont. And it was an interesting experience, right? This is both. They want to do custom silicon because they have a lot of internal workloads, lots of AI inference, but they're going to have to keep buying from the big names as well.
Yeah, it's a strategy of more is more is more. And that is for the chips, that is for gigawatts, that is a total diversification approach to securing that compute, given the insatiable demand, Ed, right now for that.
Talk to us a little bit about the M&A that was involved, Riley, to beef up the team, because Ed hinted at it in his piece there, but they were pushed back by one Japanese company, but then were able to buy a local chip-making focus.
Yeah, so early last year, Meta had made an approach for Furiosa AI, a Korean chip maker, that rebuked it. It turned down that $800 million offer we then reported in March. Later, towards the end of the year, we also reported that Meta was successfully able to acquire Revos, and with that, its bench of talent. And that was really the key here. They were able to bring in more than 400 employees who are now peppered across MTIA, this team, some of whom we met in Fremont, that are making these 4 different chips. And they're able to do that in parallel with that additional headcount.
I think the specifics really interesting. Like MTIA 300 is real. You know, Meta tells us it's in production, and they still regard that as AI, right? Training the AI that results in what shows in your timeline, targeted ads. But actually, the next step is Llama running the model. So when you put a request into Meta AI, what else did you see there? I mean, the facility was large, and from a dollar perspective, they seem very committed here.
it seems like a massive investment. They wouldn't give us a specific figure to how much they're spending on their own in-house chip work. But just seeing the products on the table, you got to believe there are billions at play here. One thing I would have loved to see was MTIA 450 and 500. These are the next generation. And
I mean, we asked. They showed us the CADs or the EDAs, but yeah.
No finished product yet, and that we're looking to 2027 for that. So 2 more being released next year, and in 6-month increments, which is really notable.
Yeah.
It was a great deep dive. I'm looking forward to seeing the next chips. Riley Griffin, thank you very much indeed. Now, in other news, Nvidia will invest $2 billion into Nebius. Now, as part of a strategic partnership to develop and build AI data centers, you guessed it, which will help Nebius deploy more than, get this, 5 gigawatts of Nvidia systems by the end of 2030. Again, this age-old circular financing question comes once more, Ed. Nvidia putting it into the end customer for its chips. Nebius, though, has a fascinating history. Of course, it's the Dutch company. It was the holding company of what was once Yandex. In fact, it's still led by Yandex's co-founder, the Russian business.
And it's basically, you know, it's one of the European names. The stock reaction, I guess, not that surprising, right? Nvidia has made several multi-billion-dollar investments in one or another layer of what's happening in AI infrastructure, but at one point up 18%, on track for his biggest jump since September. I guess a vote of confidence from the main market leader for GPUs that go into the data centers.
Yeah, certainly. We've just had news this week of Nscale and the fact that they've got new funding, got more people on the board, Nick Clegg, Sheryl Sandberg. So there's a real heating up of those neo-clouds over in Europe as well as CoreWeave over in the US.
Yeah, and it's one of the most read stories on the Bloomberg terminal. Now, coming up on the show, we're going to speak with Databricks CEO Ali Ghodsi. That conversation coming up next. This is Bloomberg Tech.
It's another day and it's another big bit of AI agent news. Databricks is launching Genie Code. It's a built-in autonomous AI assistant for really technical talent. Joining us now in New York is CEO Ali Ghodsi, who's here for a big sales event that you host here in the city. And Ali, what is this particular bit of code equipment going to do for your talent?
Yeah, so what it is, you know, we've heard a lot about cloud code and coding agents and so on. But what they do, they're kind of like interns that can write code for you. Mm-hmm. That's great. But how do you get that code into production? And for that, you need to be sure that, you know, nothing's going to go wrong, that you can measure it, and so on. So Genie Code is really about how do you actually get your code into production? How do you measure the data pipelines that power all of the dashboards that you see? And how do you even start building AI models? So what Genie Code can do is it can build a machine learning model for you that can predict prices or estimate, you know, how much you're going to sell of this. And it can do this, you know, itself. It just goes, builds machine learning models, iterates on them, does a lot of the things that data scientists previously had to do themselves. It just automates all of that for you.
And it's not getting things incorrect. As the work continues, there's still been a lot of concern that these things are hallucinating the longer term that they work. Yeah,
this is a big problem in the industry. So with this is like one piece of the puzzle is what I talked about. The other piece of the puzzle is we also acquired a company called Quotient. Right. And these are the folks behind GitHub Copilot's quality measurement. So they're folks focused on quality measurement, making sure that they can do monitoring of how things are going. So this is the other piece of the puzzle, so that we can actually do that. So that when you launch these things and they're running, how can we oversee to make sure that nothing is going wrong? Or it's sort of, if it's going off track, we can stop it, restart it. So that's equally important, maybe even more important than the first part.
Ali, it's great to have you back on Bloomberg Tech. Like, taking in aggregate, launch of Genie Code, acquisition of Quotient, how much at this stage for Databricks is it about product diversity, you know, kind of broadening the offering or suite or platform for your customers?
Yeah, I mean, that's super important, right? Because the space is moving so fast. And, you know, I think 6 months ago, we were talking about things that were auto-completing code. To now, everybody has agents that can write the code. So the question is, how do we actually make these the code that has been written into production, make sure that they're powering up everything inside of the enterprise, and making sure that we're monitoring it, making sure that we can actually start doing more interesting things with it. Can we build AI models automatically for the business that can predict the business? So, you know, to complete that puzzle and have all the different puzzle pieces, you have to expand. So it is about that, and that's why Quotient and also Genie Code have been added to this.
How defensive was that move? I think about the interesting Cursor right now, what Claude is offering on Anthropic through the coding side, your awareness of the battlefield in AI.
Yeah, I mean, those are great partners and customers that we work with, and we use actually Cursor and we use Claude Code internally at Databricks as well.
You do, yeah.
We do. But those things, they focus on how can we help software engineers? What Genie Code really can do is it brings it to the knowledge worker, the people that create your dashboards inside of an organization, and they make sure that your revenue numbers are correct, or the people that make sure that the data that's coming in every day into the organization is correct, nothing breaks, there's not an outage, you don't have like a blue screen, the dashboard is out and you can't see it, or the people that are building machine learning models that can predict your prices or your costs, or doing risk assessment with machine learning models. It automates that portion, so it's sort of very complementary to Claude Code and Cursor.
And Replit. And I'm interested in vibe coding, like we're all talking about it. And indeed, you've got some slightly less technical talent inside your business who are using Replit. And in fact, Databricks Ventures invested in Replit as of today. So how are you seeing the adoption of AI agents? What does it mean actually for the strength of your data business?
Yeah, so that's a great point. So Genie Code is really for data scientists, for data engineers. These are people the knowledge worker that understands data. At Databricks, we have 10,000 employees. About 3,000-4,000 of them are in this category that they're quite technical, and Genie Code will help them. But we have 5,000-6,000 people that are sitting in marketing or in HR or in finance, and they don't have those technical skills. Replit is excellent. They love it. It's just that these are people that would never otherwise even touch code, and they're now using Replit themselves, and they're building things that actually work. And the best part of it is, whenever you build a piece of software that works with Replit, it uses a database behind the scenes. And actually, we have very deep partnership with them. So it uses our Lakebase offering behind the scenes. So it uses that database that we offer, which is perfect for these kind of agentic tools. So I think Replit is really amazing for democratization to the broader masses, the people that you would never imagine would write a single line of code.
Hey, Ali.
Yeah.
I'm sorry to interrupt. We just got 30 seconds. I've got to ask you, where are we on Databricks' path to the public markets?
Yeah, I knew you were going to ask. Look, I don't think right now is the best time to be public. So I'm pretty happy to be private at this very moment, right, with everything that's going on in the markets. We are really excited about what we can do with AI. As you can see, we're doing all these acquisitions. We're investing. We're hiring people. So we're focused on this long-term revolution that's happening with AI, rather than having to be bogged down about, EBITDA and what's happening, in the market today. So we will be public, but I don't think now is a very good time.
Ali Ghodsi, Databricks CEO, I had to ask. Up next, Uber and Zoox. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. We check in on these markets that actually just turned negative on the Nasdaq 100. There is still a feeling of geopolitical angst, a 12th day of conflict in the Middle East with Iran, and hopes that this would be over swiftly starting to dim. In fact, they seem to be dialing up some. We're seeing oil, therefore, dial up 4.5% higher once again, even with the IEA moving in to really try and flood the market with further oil and take away that supply anxiety. It's not working on the day in terms of price point. We're looking at Bitcoin turning into the red as well. 70,000, though, is where we currently trade. Move on and look at some individual names. And I've got to keep an eye on what's happening with Amazon. Despite the geopolitical uncertainty and market moves, Amazon still managed to sell a record corporate issuance of debt into Europe. In fact, it's the first time it's tapped the euro market. We're seeing in the US, it already managed to sell $37 billion worth of US denominated debt. We're seeing the European sale up to now an equivalent of $16.8 billion. That's 14.5 billion euros. And in fact, their order book was ginormous. Once again, $37 billion worth of orders coming from that European denominated debt. Now let's look at some other individual moves, because look, Amazon is all about AWS and about capital expenditure going into AI. Well, the story on Oracle is that capital expenditure is paying off in the here and now. Investors liking the overall order book that they've built up, and indeed the growth they see in the infrastructure part of the business. Nvidia pushing up a little bit. We're losing some of our gains on the day, but it was trading higher on the Oracle news and indeed on the fact that maybe we're putting money into Nebius, $2 billion worth, up 13% for this European traded neocloud. Ed, what have you got?
Okay, China is moving to restrict state-run enterprises and banks from using OpenClaw AI apps, citing security concerns. According to sources, notices have been sent to various agencies in recent days that warned against installing OpenClaw software. Shares of Chinese AI and tech stocks slid on the report. Here with more, Bloomberg executive editor Peter Elstrom. I think explain the reporting a bit, you know, the sort of rule or notice that was sent out, and I guess also what OpenClaw is and how it's used in China in the context of that report.
Sure. Well, you guys have talked about OpenClaw a few times in the past. Of course, it's this agentic AI service that started here with Peter Steinberger, who released it to the public, and it was kind of a hit a few months ago. What people may not know quite as well is that in the past couple of weeks, there's just been a frenzy in China about OpenClaw and the service, and this idea that agentic AI can really begin to do things for you if you connect it to your messaging, your finances, to all sorts of other maybe company documents too. So it's supposed to be a plugin that you can use through your messaging service, so WhatsApp or WeChat in China in particular. And there's been this huge uptake over the past couple of weeks. We've seen companies like Tencent and MiniMax introduce plugins to be able to use OpenClaw services that are slightly modified, and their shares have really been soaring on this news. So consumers have begun to adopt it, some companies have begun to adopt it, and that leads us to where we are today, where this is an exclusive from Bloomberg, where we found out that Beijing has told the state-owned enterprises, the military, government agencies, that they can't adopt this kind of technology because there are risks. You're giving tons of access to a lot of information that could be confidential through the service, and they don't want these organizations to do that.
I mean, Austrian developer Peter Steinberger, who's now gone over to OpenAI, Peter, I mean, he was the first to admit that security and safety wasn't his first focus when building out what has become a hugely popular tool. And so therefore, is China a little bit late to the party here, not only adopting a Western-made piece of tech here, an open source one, but also one that had been admittedly already pushed back by US institutions because for fear that it would go rogue?
I think that's right. I think Steinberger was quite vocal about some of the risks here. I think he was more focused on trying to prove that agentic AI can be useful and that it can be easily accessible if you're able to tap into it through WhatsApp, for example. So I think he was more focused on that side of it. He was kind of deprecating about what the service could actually be used for. But now we're seeing it being taken up in a number of different places, certainly in the US and Europe also, and in Asia with this China explosion of interest. I think the Chinese tech companies have been very quick to pick it up and see how they can adopt it for their own market too. And I think with those advances, you've seen these organizations take it on, and some of these risks are coming to the fore. I think you're exactly right, though. Cybersecurity experts have been quite worried about agentic AI in general and OpenClaw specifically.
Max Claw being relaunched. I mean, so many of them taking on the news. Peter Elstrom, great to have the breakdown. Thank you. Let's take another look at Uber shares right now. Because as you see, they earlier in the session had spiked and now still holding on to 3% gains after the ride-hail company announced it would offer users the chance to ride in robotaxis from Amazon's Zoox, starting in Las Vegas this summer. Earlier, the CEOs of both companies sat down with Ed in an exclusive interview.
That hasn't changed. We're doing that. And I've also told you that we'd be practical about our commercial deployment. This is a big market. And so talk to Dara. And in Las Vegas and LA, we're really looking forward to bringing our experience and sort of this way to ride to the Uber platform, in addition to also being available.
The way to ride is interesting. You know, Uber is not a ride. It is a platform, a marketplace for increasingly different kinds of rides. What is it, Dara, that you think you can help Zoox do that I guess they wouldn't otherwise be able to do on their own?
Well, we bring enormous distribution on a global basis. And I think that there's this narrative of it's either or, you know, either you go direct to your customer or you go through a platform. And the fact is, if you look, for example, on Uber Eats, you have some of the best brands in the world, whether it's a McDonald's or a Starbucks or Chipotle, having a direct interaction with customers through their own apps, but also using the platform to expand their distribution. And I see the same thing with Zoox as well. You know, Zoox is on his way to create one of the best brands in the business in transportation.
Which you've experienced recently, right?
Absolutely.
You went and took a ride.
It's a great experience. It's a purpose-built vehicle. And to have that experience on Uber we think will only magnify what Zoox is bringing to the marketplace.
This is small scale in the first instance, right? You know, Las Vegas, and then where you're already active, and then LA. The mechanics of it are interesting, right? Because as a rider, you are not guaranteed in the first instance that you can choose a Zoox. It's algorithmic. It depends on the circumstances for you to have, I think the language you use is the opportunity to be matched with the Zoox. I guess supply in the first instance is why you've pursued that plan at first.
Yeah, but really no, because look, it's a platform. It's a global platform. It's available. You have all kinds of people who show up in Las Vegas. Some might know about Zoox, some might not. And the ones who don't probably know about Uber. So why not take advantage of that? That's really all it is.
This is early, but would you just explain, I guess, longer term what the business plan is? Is there a per ride revenue share agreement? How do you split the fare when you're able to charge a fare, Dara?
I think for us now, the focus is going to be the customer experience. We want to make sure that whether, obviously, the Zoox direct experience is going to be best of breed, but also having the experience through Uber is going to introduce you to the differentiated experience on Zoox as well. That's really going to be what Aisha and I are focused on. You know, I would say the economics take care of themselves over the long term.
Data is going to be critically important here. So let's start, I guess, Dara, with what data sets can Uber provide Zoox that help them with scale and data sharing that you've got in place?
Well, we are certainly going to work with Zoox in terms of traffic patterns. And now Zoox is going to have access to that data directly as well. But I think the combination of the traffic patterns that we see and the customers that we see, whether local or international, along with Zoox's proprietary data, I think is going to help Zoox be even more efficient as an entity going forward.
Yeah, and I'll add to that also the experience of dealing with things, or just starting to deal with large events, things that Uber knows how to do in their sleep, and will essentially speed up our knowledge of doing that.
That was Uber CEO Dara Khosrowshahi and Zoox CEO Aisha Evans. Now, coming up, Michelle Volz, formerly of the American Dynamism team at Andreessen Horowitz, joins us to discuss her new fund and its focus on investing in technical superiority. What a conversation to come. This is Bloomberg Tech.
The conflict with Iran, well, it's highlighting a concern some investors and many others have been flagging for a while. Expensive, hard-to-replace weapons are being used to counter cheap Iranian missiles and drones. Now today, Michelle Volz is joining us, who's a former member of the American Dynamism team over at Andreessen Horowitz, been investing in startups looking to address the costly, the slow, the sometimes missing parts of the US industrial supply chain. And Michelle, you've just launched a new firm, Pax VC. You've raised $50 million. You're looking at early stage. But I'm really interested in just this moment that we're in of geopolitical tension, of conflict. And you as an investor in defense tech, but more broadly in supply chain and American dynamism, what do you make of this moment?
Yeah, I think the conflict has really highlighted the gaps that we have in our industrial base. We've outsourced a lot of our manufacturing overseas to China, and now we're realizing we need to be able to resupply our weapon systems, our components. We need to manufacture these things domestically in-house. We need to shore up our critical minerals supply chain. And so many of the companies that I'm investing at and looking at, whether back at Andreessen Horowitz or now, are really focused on this industrial base and making sure that we can, in any sort of future conflict, have the capabilities domestically to be able to fight back.
I mean, look, the name says it all, because Pax, we think of Pax Britannica or Romana or Pax Americana, of like sort of the dominance of one particular global force and the stability that brings. But you've talked about how in this competitive area that we're currently in, maybe Pax Americana isn't so solid, but you're looking at Pax Technica. So where in particular are you excited about? Which particular technology innovations have you found it worth to put your money in?
Totally. And I mean, I think the name Pax, like you said, says it all, where the eras of relative stability have been defined by who is in power and who has the most technological power. And I think for us in America to be able to ensure continued relative stability in the world, we need to make sure our our robotic systems are incredible, our supply chain, and our ability to mine and refine critical minerals. I invested in a mining company called Mariana Minerals that's working to reshore all of our capacity to bring all of these critical minerals to the industrial base. I think looking around corners, what should we prepare against for future threats? We should be looking at biosecurity and biodefense. We should be looking at all sorts of things on the AI and what that does for cybersecurity. And so I think there's an element of like, how do we reshore and reindustrialize, and how do we see around corners for what are the threats coming next?
Michelle, hi, it's Ed. It's good to see you. Welcome, to the show. Go back to basics just for a second. So you were at Andreessen Horowitz, and you were part of this American Dynamism team, and the thesis was like simply supporting the national interest. And you've decided to go out and do something almost solo, right? And I just wonder if you reflect a little bit on the decision making behind that, the pros and cons of going from such a big team within a big firm to doing this with Pax.
Totally. And Andreessen Horowitz is an incredible place. Like some of the the most brilliant people, lots of scale. But I love the early stage, and I love the sort of 0 to 1 when companies are just getting off the ground. And at that point, you don't quite need the firepower of a big multi-stage. You almost need a trusted partner in the trenches with you, helping like block and tackle for all the small things of like getting a company off the ground. And then you can bring in these big multi-stage firms that have all these resources to really pour gasoline on the fire that starts burning. And so it's just my favorite stage to be, and I love being really, really close with the founders there.
Without putting words in your mouth, you talk about this idea that often the founders themselves are kind of ahead of the VCs that are backing them, even if they're like, VCs that have the operator background or the founder background. How are you going to catch up? How are you going to put yourself in a place where you are moving at the same rhythm or pace as the people you want to back?
Totally. I would say my style of founder that I like is somebody that has a lot of experience in the domain they're going after and a sort of unique view or a unique right to win, even if that is a category that hasn't yet been mainstream or people have seen. Like the founders should be the ones dictating what is the future. And if you start to see patterns of, okay, a lot of smart people are working in this category, it feels like even if I haven't seen it, like they are seeing something and I should really spend more time and get up to speed. But really it's all about like having a network of experts in these domains to be able to bounce things off of and get the ideas, solidified. But like the founders should be the smartest people in the room. Venture capitalists should not be.
Michelle, just really, really quick. Did you take any portcos with you? Like, how does that work? We just have 15 seconds.
I invested through my fund in some of my old Andreessen Horowitz portcos, which is a very big honor for them to want me back on their cap table.
Appreciate that. We just wanted to check that one. Michelle Voles, founder and managing partner of Pax VC. Thank you for your time. Carrie, we've got some more news.
Yeah, it's time now for Talking Tech, Ed. And first up, Anthropic. But it's told a judge it could lose billions of dollars in revenue this year after the Trump administration declared the company a U.S. supply chain risk. Now, the startup made a case for urgency to the San Francisco judge a day after it was sued the Defense Department. Now, a hearing is set for March 24th. Plus, Grubhub, well, it's going to test drone delivery of takeout orders for the first time as part of a limited 3-month pilot program in the area of Greenbrook, New Jersey, starting next week. Now, this is the company's latest experiment with automation technologies after using sidewalk robots on some U.S. college campuses. And Nintendo. Shares gained as much as 10.5% in their biggest rally since April as a surprise success of the new Pokemon game helped offset those worries about rising memory costs. Physical copies of Pokemon Pokopia have sold out at several major retailers in the US, with Amazon even raising its price to around $80. Ed.
Okay, coming up, we're going to hear from the Synopsys CEO, Sassine Ghazi, on how AI is reshaping the company's product cycle. This is Bloomberg Tech. Last year, Synopsys closed a $35 billion acquisition of engineering software firm Ansys. Now, the focus turns from integration to execution. We spoke with CEO Sassine Ghazi about how AI is transforming chip design and manufacturing. Take a listen.
What our customers are facing, beside the supply chain challenges and the global stress that we're dealing with, there's a shortage of engineering. They cannot get enough engineers to deal with that complexity. So AI helps augment the existing engineers. The second aspect of it, reducing the cost. You can reduce the cost by improving the yield. Memory is a fantastic example. No matter how much the memory companies try to expand capacity by building factories, you need to be able to have better yield. That's where we come in to help them design the actual physics of manufacturing with the design phase to improve the yield. So those are the components, and reducing the design cycle. Traditionally, chip design was 18 to 24 months. Now you have customers like Nvidia and other talking about the design rhythm of 12 months. That is not possible without injecting AI everywhere in the flow. And when you go to manufacturing, you're able to improve your yield.
Sassine, what conclusions did you reach in recent weeks after the sell-off in software names about the long-term definitive impact that AI will have on EDA? You're one of the biggest EDA names, right? But you're not the only one.
Yeah, unfortunately, it was a naive approach to say that all software is the same. You're going to have some software where LLMs, foundation models, yes, is a perfect application to, let me call it, replace. But when you look at the engineering software, I'll go back to the physics aspect of it. We run, we code, and we deliver software to our customers, but that's not the moat. The key differentiation are the solvers to translate from an architecture design to an actual manufacturing product. So I believe it was absolutely an overreaction by putting every company that delivers software in the same categorization.
Synopsys CEO Sassine Ghazi there. Let's turn our attention to Google now. And it's aiming to battle AI slop videos on YouTube and YouTube Kids. By backing companies it sees it actually creating high-quality AI content. This includes a very small but focused $1 million strategic investment in an AI animation studio, Animage. Let's get more with Alexandra Levine, who covers social media for Bloomberg. Look, 1 million is but nothing to Google, but it's saying something about what content it wants to back.
Exactly. 1 million is nominal, not only for Google, but also for the company, which has raised a ton of money over the last several years. But I think what is significant about Google's backing of this company, Animage, is that it is really making a bet that AI can be used to make really strong quality content for children who are using both YouTube and YouTube Kids. They have had a problem over at YouTube, especially over the last year or two, with AI slop and with content that a lot of parents and child experts think is more exploitative than educational for children. And so this is really a swing to try to take that on.
Alex, for the Bloomberg Tech audience, what is AI slop?
AI slop is what we are now often calling spammy, clickbaity, repetitive, low quality, slimy looking content that you see not only on YouTube, but also on pretty much every major social media platform at this point. And it is often repetitive, something that I think is particularly concerning for younger viewers because they are really developing their brains at early ages when they start watching a lot of this stuff. And so that's why there has been a bit more attention on AI slop for toddlers, babies, and children.
I mean, Animage, co-founded back in 2022, is an extraordinary, billions of views. Why is it the first kids media business for Google to back?
So it is not the only kids media business out there. I think the biggest, probably best known competitor of Animage is Moonbug Entertainment, which is the company behind things like Cocomelon and Blippi. But I think that if you look at some of the Google AI accelerators, other investments, you'll see that they are very much focused on other companies in the media space. This is the first, I think, focused on the kids space, which I think says a lot about its priorities for 2026.
Bloomberg's Alex Levine, thank you very much. Jam-packed, but that does it for this edition of Bloomberg Tech, Kara.
Yeah, don't forget to check out the podcast. You can find it on the terminal. You can also find it online on Apple, Spotify, and iHeart. From New York and San Francisco, this is Bloomberg Tech.